Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it's my pleasure to be your host for today's episode. In today's podcast, we'll be looking at what happened in August 2025, and we'll be discussing the outlook going forward. This podcast is being recorded on Monday, the 1st of September 2025, and joining me again today is our investment officer, Rob Hogg.
Steve, how are you?
Very good, Rob, thank you. Welcome back again. So let's have a look at what happened over the month of August. The S&P ASX 300 accumulation index rose 3.2%. The Small Ordinaries accumulation index rose 8.4% and continued on the outperformance that we've seen in recent months of small companies versus large companies. The US equity market, the S&P 500, rose 2.1%. Australian 10-year bond yields were basically flat at 4.27%. The Australian 3-year bond fell slightly to close at 3.37%. The US 10-year bond fell by about 0.16% and closed at 4.23%, while 2-year bond yields fell by 34 basis points to end at 3.62%. The Australian dollar moved higher against a US dollar which continues to weaken and appreciated up to 0.6536 US cents. So Rob, let's start by having a look at some of the highlights, which we'll touch on. And so let's start with one of the most important speeches, I guess you could say, over August, and that was the Fed Chair Powell's speech at the annual Jackson Hole Central Bank Conference. Can you walk us through what he said and what implications it's got for interest rates?
Thanks, Steve. As is pretty much always the case, any time the chair of the biggest and most important central bank says anything, the market really hangs on his every single word, including what he says and what he doesn't say and the order in which he says what he says. But the key issue, I think, about this particular speech was that following on from their prior July meeting where the Fed committee said they'd be prepared to adjust the stance of policy as appropriate if risks emerge, he's then moved from that several weeks later and been considerably more dovish than the market expected. Indeed, he said words to the effect with policy in restrictive territory. So by that he means that rates are probably higher than they're going to end up. So with policy in restrictive territory, the baseline outlook and shifting balance of risks may warrant adjusting our policy stance, presumably towards a rate cut. My words at the end there. So that was obviously very significant, and that was toward the end of August, and that had a significant impact on equities and has assisted equity markets during the course of the month, and bond markets too.
So talking about bond markets, what happened in bond markets around the world over the month? Did they rise? Did they fall? Are they about the same?
Well, they did a little bit of everything, but broadly speaking, they all steepened. So what that means is that in a bull steepening scenario, what we're talking about there is shorter term rates falling by more than longer term rates, and that's what happened in the US. Or in a bear steepening, which is pretty much what happened in Australia, you get, in fact, a slightly higher level of yields at the very long end and a slightly lower level of yields at the short end. And that's what we mean by steepening. It can be bullish or bearish according to whether interest rates are going up or down. But the clearest example of this during the month was the US, where short-term interest rates fell quite significantly, and a lot of that was because of Chair Powell.
Right, and then the longer term, say the 30-year government bond yield, that actually rose.
Well, it's mixed around the world, and this is a very interesting thing we've seen now for some months, beginning really in Japan about a year ago, more so in Germany this year, and a little bit in the US as well, and the UK. We've seen 30-year bond yields start to rise, whilst 10-year bond yields, I mean, we talk about them every month, they're up, they're down, they're up, they're down, they're out. But they haven't really, 10-year bonds, moved out of the long-term trend they've been in for a couple of years. But we're starting to see 30-year yields move a little bit above that area where they have been. And investors are really starting to worry and wonder what that exactly means. Perhaps it's investors making a reassessment of things like fiscal sustainability and concerns about budget deficits being run at much, much higher levels, certainly than they were pre-COVID. So perhaps that's what we're starting to see at that very long end of the curve.
Yes, because in isolation, say, looking at the 30-year French bond yield, is almost 4.5%, and the 30-year US bond yield is almost at 5%. If you take away inflation, they're both net real positive yields, aren't they?
They are. And what's important in Europe and what's important in the US with these very long-term yields is that more borrowing tends to occur, certainly than in Australia, with those sorts of tenors. So in the US, for example, the housing market, mortgage rates, almost every mortgage in the US is a fixed 30-year term. So what the 30-year bond does has a very immediate impact on mortgage rates in the US, and we'll come back to it in a sec, but perhaps that's one of the reasons why the housing market in the US is looking quite sick.
Well, before we get onto the housing market in the US, I know that's an area of interest for you at the moment, but can we go back a little bit to inflation? So what's happening in Australia, what's happening in the US and Europe?
Yeah, so they're really contrasting stories in Australia, inflation expectations, and we measure these by looking at just the conventional government bond, and we subtract from those conventional or nominal bonds, we subtract from that what are called real yields, and the difference between the two is the implied inflation expectation. So difference between the nominal yield and the real or inflation protected yield. In Australia, that's relatively stable, but inflation expectations have started rising in the US and Europe. So again, US might be investor concerns about fiscal sustainability. You recall that Trump had passed through the Congress his big, beautiful bill, and that's all about fiscal easing, so higher deficits. And of course, in Europe, the key there has been the very significant spending package announced by the German government along the lines of infrastructure and defence spending. So perhaps that's what we're seeing there. And in Japan, it seems to be just a reassessment of market expectations about inflation and growth as well. But it's quite significant and it bears watching. It's not in any dangerous territory now, but the bond market is about the only guardrail that President Trump respects and notices.
Right. Look, one of the key things that goes into long-term bond rates is the expectation of inflation, and obviously the tariff hikes that we've seen in the US are going to feed into that if they haven't already. So where are we at with the tariff rate at the moment?
Well, there wasn't a lot of news on tariffs over the last month, and that's enabled us to make a bit more of a judgment about where they've settled, and the answer is between 15 and 20%. So that's significantly higher than tariffs were prior to Liberation Day, the 2nd of April. But the market has just looked through that. Key here will be the inflationary impact, with most everybody expecting there would be some inflation impulse from tariffs. But so far, it's been less than expected. We hear anecdotally about the fact that exporters to the US are taking cuts on their landed prices into the US. And there's other margin compression that happens through the distribution cycle and so on. Manufacturers as well are taking a hit on their margins. And what all of this means is that at the consumer price level, which is what the Fed's all about, there's really scant signs so far. There are some, but there's nowhere near the amount of inflation impact from tariffs as was feared.
And Robert, it's interesting, isn't it? Because I think, we're seeing countries have got to adjust to the new order. And if we look at China, then you've got a situation where exports are still growing. And I think it was roughly 7 to 10% for the year on year. So clearly China is looking for other countries to sell its goods to. Is that a fair comment?
Yeah, no, I think that's how it's going to pan out. European, it'll be the same with every other trading partner of the US, including ourselves. We will be increasingly seeking out other trading partners around the world. So a lot of the impact globally will be mitigated by just the simple redirection of exports, which is why we continue to look at the US, because that's where you would expect to see the nub of the impact.
So just back on, you mentioned the housing market in the US. It's a big part of the US economy, and not as big as Australia, but it's still a very big part. It doesn't look that good, does it? And the 30-year bond increasing is putting more pressure on it.
Yeah, that's absolutely right. One of the interesting sorts of impacts of this is that, as you can imagine, if you have your 30-year mortgage that maybe you got several years ago, and that mortgage rate is lower than the current prevailing rate if you've got a new mortgage, It's a significant constraint on actually selling your property and moving to a new property. And what we're seeing is that housing starts and building permits, which are the two sort of key indicators of housing activity, they're just continuing to slip away. And we can see that confidence from builders is also ebbing away as well towards some of the weakest levels we've seen for quite a number of years. So look, I think a lot of this is about the 30-year mortgage and the level.
And it doesn't, I mean, at the moment, the trend is down. So, you know, we're not predicting a recession in the US, but certainly parts of it are, as you say in your monthly report, displaying recessionary type conditions.
Yeah, housing definitely.
Yeah. So just back on the US inflation outlook with tariffs feeding through and so on, how's the equity market looking at it? Is it worried yet?
No, seemingly not. During the month, the market pretty much looked through the CPI, which was sort of as expected. Some of the underlying measures, however, were a little bit higher. So some of the ways we look at the CPI are things like what's called the trimmed mean, which strips off the two outer extremes of price increase and price decline, and the median, which is the midpoint. Those sorts of measures are starting to rise a little bit. The one inflation number that did actually have a bit of a market impact was what's called the producer price index, and that's sort of like an upstream manufacturing price. And that came in quite a lot higher than expected, and that did have a negative impact on the night. But together, over the course of the month, neither of these numbers were enough, really, to cause equities to have a significant rethink.
No, and look, it's a non sequitur, but it does feel like almost nothing can derail the market at the moment, whether it's good or bad news, but things change as we know. So looking at the tech stocks, they've obviously been fantastic performers over the years. How are they going? And they're obviously reporting season in the US. There were some negative announcements.
Look, by and large, they've tracked okay, although one of the features of the month was really that small caps did so well in the US. And I think a lot of that's to do with the monetary policy outlook shifting. And of course, lower rates are most positive usually for the domestic economy, and small caps are most affected by the domestic economy. But we had another interesting sort of development in this whole AI tech area during the month. A report came out entitled The Gen AI Divide, State of AI in Business 2025. Now, this is a survey carried out by some researchers at the Massachusetts Institute of Technology, so a very reputable source. And they made the claim that despite all of the investment into generative AI, so 30 to 40 billion US, the report, which was a survey, uncovers a surprising result in that 95% of organisations are getting zero return. Now, this is important for a couple of reasons, mainly because the market has been buying companies that are benefiting from the Gen AI related capex. And if anything were to upset the idea that spending on AI capex may not give the return expected, it could be a very real risk to AI and other tech-related spending. And of course, that's particularly important because these stocks have run over the last several years incredibly hard, and particularly in the last couple of months. So if anything were to sort of upset that investor psychology in AI capex-related growth, that could have quite significant impacts on that sector. And we know how important that sector is in terms of its size. We know how important that sector is in terms of driving earnings as well across the broader US market. And of course, we had DeepSeek earlier in the year. And I don't know, perhaps we'll look back and say, well, these were a couple of canaries in the coal mine.
And it's interesting because a lot of these organisations don't yet make profits. It's really the very long-term cash flows that investors are buying at the moment. And so the share price is incredibly sensitive to the long-term growth rate. And I guess what you're saying is a small change in the long-term growth rate can have a huge impact on the present value of the share price.
Yeah. When that second derivative, so that rate of change changes, particularly for expensive stocks, high PEs, high growth, if that second derivative changes, so the rate of growth slows, that can have a very outsized impact.
Okay, well, let's move to Australia. So the Reserve Bank cut rates as expected in mid-August. We expected it last time as well, and they didn't cut rates. So I guess at least we got one out of two, as did the market. But there's been a little bit of a change since they cut the rates. As a couple of economic indicators have come in that maybe push the rate cuts down the road. Is that right?
Yeah, no, I think that is the best way to think about it. And in fact, even the statement when the RBA cut rates in early August, it was a fascinating thing to read. As much as these things are fascinating, this is one of the more fascinating ones. What the RBA said as they cut rates was that the cash rates assumed to follow a gradual easing path, and that's really because the RBA expects the inflation rate to continue to sort of ease through time. But apart from that statement, right up the very front of the statement, pretty much all the rest of the statement was quite balanced and didn't really give any indication what the next rate move might in actual fact be. For example, they said more extreme tariff outcomes are likely to be avoided. Well, that's a positive, but I think they're talking about the impact on growth there, but also inflation, to be fair. They said private demand appears to have been recovering gradually. Real household incomes have picked up and some measures of financial conditions have eased. Financial conditions refers to the combination of interest rates and asset prices. And then they went on to say various indicators suggest that labour market conditions remain a little tight. And then they finished up saying the board will be attentive to the data and the evolving assessment of risks to guide its decision. So there's nothing in that to indicate direction. So it's really only the statement at the very top where they spoke about expected further easing in inflation, which will be met by rate cuts. But as you were alluding to, I think the risk is that the rate cuts are less than expected or will take longer to occur. And we can look at things like the CPI, the most recent monthly CPI for July. Now, these do bounce around. They're not as good as the quarterly numbers we know. But for July, the annual rate of change rebounded to 2.8 from 1.9 over the 12 months to June, and underlying measures were higher as well. And there's a number of these confidence and forward-looking numbers as well that we've been talking about that are pointing to a pickup as well. Consumer confidence is continuing to move higher, and the Westpac Melbourne Institute group that put this together talk about improvement in sentiment being broad-based, and also that the improvement really follows the August easing. So now we've had 3 rate cuts. Consumer sentiment is rising, corporate confidence is rising. We had a big bounce in the latest S&P Global Australian PMI, and that was really driven by orders.
PMI as in?
Purchasing Managers Index, I beg your pardon. And employment remains pretty stoic as well. Employment and hours worked both rose in July. So if you put all that together, rising household confidence, rising corporate confidence driven by new orders, inflation that's bouncing around, it's within the band, but it did bounce higher, and employment that remains relatively robust. It's not, if you just landed in Australia and you looked at all these numbers, I don't know that you'd be banging the table and saying, rate cuts, rate cuts. But to be fair, market pricing is for a rate cut not until June, not until November, and then sometime next year. But it's possible that those get moved out even further. Now, that's in the absence of the US just suddenly careering into a hole, because that will have global implications. But as far as Australia's concerned, really, activity in the outlook looks pretty good.
Well, that's good to hear, although it's not necessarily translating through to earnings of companies. And we're pretty much at the end of the reporting season. The August is the time of year when most companies report their full year returns. Can you just talk through some of the themes you're seeing out there?
It's been an extremely interesting reporting season, and there have been a number of features that have really been quite incredible. One of those is really just the huge post-result volatility in the stock prices of some of the largest companies that are listed on the stock exchange. So CSL, James Hardie, for example, experienced incredibly large negative price falls following the release of their results. Now, these are amongst the very biggest companies on the ASX. So it's not generally, and it's not historically, where you see this much volatility. But we saw that with both of those companies. We've seen and continue to see an elevated level of change in management ranks. And that may have something to do with the whole CSL story. But that is, obviously there's a cycle, there's a corporate cycle, management does come and go, but there seems to be a higher than usual level of change in management ranks at the moment. But look, some of the positive stuff, there's clearly improving consumer spending trends, and we've seen that across household-related goods, but also other areas of consumer discretionary, and that's been one of the very best performing sectors during the month. We've seen increased discussion of the use of AI by business, but few examples so far. So look, talk is cheap, but at the moment it's very fashionable to talk about AI. The gold sector's been quite amazing. Significant increase in capital raising activity there, mainly to fund exploration, but that just reflects the very high level of confidence in the sector. And also reflecting confidence, a number of companies announced better than expected dividends, including several special dividends. On the property side, we've seen hints of improving inquiry levels. Well, the developers have, but so far not a lot of flow through to actual housing starts. Building costs are still a very significant factor. Weakness in the US economy came through, especially housing, so a lot of that was what we saw with James Hardie, but there were other Aussie companies that spoke of very similar things. We continue to see underperformance of the Victorian economy compared to the rest of Australia, and just finally, there seems to be ongoing improvement over in New Zealand, which you sort of hope to see after they've cut rates quite a number of times.
Well, there's a little bit more to come in the reporting season, but we've pretty much covered it. So wrapping all that up, Rob, how do you see things going forward? We have been a little bit cautious over the last few months, and that's really because the fundamental outlook is not that positive necessarily. Earnings growth is not huge, but the share market has gone up, and part of that's obviously the rate cutting cycle. But how do you see it going forward from here?
Well, look, we said a month ago that we'd become more cautious. And look, if we absolutely remain with that same level of greater than usual cautiousness about the market outlook. So there's several issues, the most important of which is probably valuations. So valuations globally are towards the very high end of their range. So what that means is for the market to continue to rise, you need to continue to be surprised on the upside with earnings.
Or perhaps interest rates.
Or indeed interest rates. So you need inflation to be extremely well behaved, and you need central banks to be cutting rates because inflation is extremely well behaved rather than because growth is very weak. So basically high valuations mean things have to go well because a lot is priced in. In the US, the jobs market, the employment market broadly continues to soften. It's still been a modest rate of slowing, but that continues. You don't want that to suddenly morph into something faster or more serious, because that will not be good for expectations about earnings. And ideally, for the Fed's sake, it'd be a lot better if inflation momentum in the US was actually easing, not accelerating, which is what it seems to be doing. And just finally, for investors, really, the stature, the standing, the independence of the key central bank, that is absolutely paramount. And really the last months, and particularly August, have been marked by, if anything, an increase in really the very, very belligerent language by the President in regard to not only the institution of the Fed, but also some of the Fed members as well, and not just the chairman now. So those kinds of things run the risk of debasing in investors' minds the independence of the US central bank. And were we to see that reflected in market pricing, it would come through in higher risk premia. So what does that mean? That means lower PEs and higher interest rates is how you would sort of expect that to be through. Here in Oz, look, we're much more sanguine about the prospects in Australia, absent the July bump. Inflation does seem to be moving down. The economy does seem to be improving. We've only just really started on our rate cut cycle. The RBA can quite legitimately cut rates again with that inflation momentum easing. And of course, we've got very significant potential fiscal firepower because, I mean, much as we might see on the front page of the paper that the budget's not behaving as well as we'd all like, it is truly a relative thing, and relative to most of the rest of the world, the Australian budgetary situation is in a very good spot. So we basically have ample more firepower and more flexibility to respond should things globally or domestically turn sour.
Great. Rob, thank you so much for your time. That brings us to the end of today's podcast. We looked at what happened in August 2025, and then we looked forward to what it means for investors going forward. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcasts from. And please let us know if you've got any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not constitute financial advice and assumes a certain level of knowledge. It's general information only and does not take into account the investment objectives, financial situation, or needs of any person, and should not be considered a recommendation.